with us on the show. Nirav, good morning. Thanks for joining in. Could it be sell in May and go away for Indian markets? Or will it be difficult to predict May until we know the resolution of the conflict?
So, good morning, Niraj. And, I don't know why we are even keen to predict what happens in May, right? So, you made a point that, we can't necessarily call out the resolution of the conflict. And the channel that it hits us through is obviously the capital flows and the current account deficits because of what happens to the oil prices. But I think the general expectations of the market is that, there'll be a resolution sooner than later, because if you look at the last I checked, the December crude futures, they were trading at about 74. The current Brent prices are about $110 and all. And it's very asymmetric. I've held this view for a long time. So far, I've been wrong, right? So, it's not that Iran is trying to win the war, right? They're just trying to have a saving face so that once you called out ceasefire for good, the current regime has legitimate reasons to rule, right? So, so I'm in an optimist camp. You still have earnings growth in the region of about 12% for FY27, trading at roughly about 17 odd times, which is lower than last 5 year historical averages. So I'm fairly constructive on the markets, Niraj.
Interesting.
And I mostly am.
But Nirav, the point being, the telltale signs are not necessarily the most positive, because two things, right? Three things actually. We don't know when the conflict will end. Frankly, at best, it's a guess. Nobody quite knows. Brent, as we speak, is at 111, which is what it was during the worst period of the conflict in the last 30 days. So in some sense, no respite from crude either. And almost every FII that we speak to, or a broker who caters only to FIIs, says that their clients have a lot of options right now. They don't want to come to India because other markets growing better are available cheaper. Why should Indian markets do well?
Right. So I think, to get slightly into more details, right? So you can make a case that, for example, South Korea is cheap, right? Because earnings are growing very fast and that's a part of an AI trade. So let me give you a sense, right? You can argue that TSMC or some of these memory companies, Hynix and all, they're trading at about 8 or 9 times earnings, around 30%. The variability in their margins is from 5% to 85% operating margins, right? Today you're operating at 85% operating margins, right? And therefore to try and assume that you will have peak multiples on peak margins doesn't necessarily make sense. So that's the nature of the beast. It's like saying that Hindalco trades at 6 times EV to EBITDA. It deserves to trade at 6 times EV to EBITDA. I concede that, unfortunately, India is not there in this AI space ecosystem. That is something that we need to find a solution to this, right? My personal view is that it is a tremendously, path-breaking technology. We don't know when it's going to hit us, but it is surely going to hit us at some point of time in the future. To that extent, we are not a part of that AI trade. And my personal assessment is that it is not so much about growth. It is about the fact that we just don't have an AI play. And therefore, when you're talking about a $5 trillion market cap of NVIDIA, when you're talking about 1.5 trillion market cap of TSMC, we don't have a corresponding bet in the Indian market, right? And to that extent, I think, yes, will not be the favored market for the FIs. Now flip the question and think about it, that what are the options that the Indians have got? You got fixed deposit, which is sort of getting about 5.5%, 6%. Property markets are almost giving you a similar kind of returns. And in the worst case scenario, you end up going 9 or 10% in the Indian market. So you should not get too worried about where the Indian savings are going till the time we open up capital convertibility, which is not going to happen for a long period of time. It's a cause of concern.
Okay, Nirav. Okay, so good point. But So the argument, I think, my opinion, and so
Of course.
it should not be that we don't have an option, and so therefore we have to invest in equities. That is actually something that shouldn't come to pass. I'm just focusing on the 12% earnings growth that is being penciled in. I'm wondering, Nirav, if that is a little optimistic given what we know so far, and the fact that Brent is likely to stay elevated as per anybody's guess. At this moment, it's at 110 plus. So do you think that you might have to revisit that maybe towards the end of the first half?
Well, very possible. So one of the things that we want to keep in mind is that the 12% earnings growth we are talking about now for FY27 also comes on the back of the fact that my FY26 earnings have been downgraded to some extent, right? So also please try and appreciate the fact that, let's say this conflict were to continue for 3 or 4 months, and it's very likely that we will have a couple of percentage notches downgrade in the earnings. That doesn't do anything to my FY28 earnings. Please understand that. There is only so much valuation that you will give to my next 2 quarter earnings. A lot of the value for most of the companies will sit in terminal value, right? Unless you are making a case that India is a banana republic, and then, so even if you take $110 today, the total hit to the government, right? If I don't increase my retail prices of the petroleum, will be close to about 3 lakh crores for the entire year. You are running a gap of roughly about 15 or 18,000 crores a month on petrol and diesel, and you add about another 8 or 10,000 crores that is coming because of reduction in excess duties that the government has taken. Is it a hit? Of course it is a hit. But can we take it on our chest and move on? Of course we can take it on our chest and move on.
Okay. To what extent, and Nirav, the follow-up to that is that the impact of this is going to be unequal, just as geopolitically, and if you look at it globally, the impact of the conflict is also unequal. If you look at higher energy costs, there will be pockets of resilience, relatively speaking, and there will be opportunities to be had as well. People have been talking about the energy transformation story as one of those. But the only point is that if you look over the last 1 month, the kind of rally that you've seen across the board in April means that if you're trying to deploy right now, quite a few of those opportunities don't look as mouth-watering as they did earlier.
Yeah, exactly. Because, a month back, you would have worried more about what is going to happen to the conflict. This is exactly what we are discussing right now. And there's a price to pay for that, right? So every time that you want to have more certainty, you'll have to end up buying something at a price which makes you slightly uncomfortable. But in the same camp, I think electrification, renewables, these are big themes, and it's high time that India understands that. You are spending about $110 billion on oil. Why would you not spend a couple of $1 billion in subsidy and try and, force feed the electrification story going forward? And this will happen as we move forward. So, yeah, you need to be slightly more, the point I'm trying to make is that it is during this period of uncertainty that you'll have to try and deploy the capital, right? So, we've gone through pandemic and see what has happened, right? You're nowhere close to what was happening in pandemic. So, and we'll have these kind of problems occasionally. It happens all the time. There's nothing new.
Okay, Nirav, I saw a note from the house of Emkay around how your 13-day trip to China leads you to believe that there is maybe a cycle of sorts coming into chemicals. In fact, if I'm not wrong, the note said that for bulk chemical producers, there could be a new bull cycle coming. Tell us, because this sector has been a bit of a slumber for the last 5 years.
Well, I'm not an expert on that. I
Sure.
think the limited point that I think the note tries to make is simply the fact that, and this is a well-known story, the involution story that we are talking about in China for a long period of time. You're seeing that is now being played out even in electric cars. Just look at the BYD results that were declared yesterday, right? The profits are down significantly. So I think it is coming to a stage that beyond a point of time, your cost structures move up, that the prices have to move up. And that is the limited point that we are trying to make over there. And obviously, the stocks have not gone anywhere over the last 3 years. So you had a pandemic-induced supply shocks, the prices ran up, the profits peaked out, and from there, there's been consolidation. And we believe that that consolidation phase is by and large over. And then within that, you look at which are the chemicals that try to benefit and which are on the positive side of the trade. But yes, the limited point is that there is a pricing discipline that seems to be coming around in parts of that sector for sure.
Okay. Nirav, one last question. Autos, a quick 1 minute, please. But autos peaking out, you think? I mean, market discount 6 months ahead, GST benefits will go away or the base effect will go away, oil higher, etc. Autos peaking, you think?
So I think that we have got a fair line of visibility in terms of where the volumes are going to head. But our understanding is that you may want to look at four-wheelers with a different spectrum and two-wheelers a different spectrum. There is far more disruption that is happening in four-wheelers, right? So you got this Nissan and Renault and all of them are coming back. Electrification is picking up and new leaders are emerging in that space, right? And you had a similar kind of disruption that happened in two-wheelers, which is now well settled, right? So you got Ather and you got one more guy and then the incumbents have come back very strongly in that space. We are far more constructive on the two-wheeler space. And then we believe that against passenger vehicles, probably even commercial vehicle makes sense. Obviously, there are concerns about increase in diesel prices and all that. But the volume trajectory and the competitive scenario over there is far more secure for the incumbents than it is for the passenger vehicles. So that's a broad take. It is not so much about the volumes for cars, but in terms of how that profit mix shapes up in the next couple of years. And the valuations will depend on that.
Okay, Nirav, we'll leave it at that. Thanks so much for taking the time out and being with us today. Really appreciate your time.
Thank you so much for having me, Niraj.
Well,